We got a massive warning in the stock market yesterday. Stocks opened hard lower. We saw the indexes that were down close to 1%. And later on during the day, it did bounce, but however, it still closed with some real undeniable technical damage. We saw the S&P 500 as we are looking at right now. It did actually open below the 200 EMA, the daily EMA, and even though it closed above, you can see that right now we are testing at this very important technical support area. And when we look at the Nasdaq, we do also same. Nasdaq has also reflected the same thing as what we saw in the S&P, testing the 200 EMA after a long time. And Dow as well, we are already broke the 200 EMA, and we are going down to test right at the October lows very soon. Now, this matters because it was not just a bad headline day, because the market had to reprice a few things. Reprice the geopolitical risk, the inflation risk, and the rate hike risk that has now been on the table all at the exact same time. And the later rebound we see did not actually fix it, right? It just shows how desperate the market is looking for any worst case scenario that will not happen. The catalyst behind the move we saw yesterday wasn't just geopolitical in a general sense. We all know that the war is still ongoing, there are new updates, but more of it was actually energy infrastructure. So what we saw yesterday was that Israel actually struck the South Pass gas field, and Iran responded by targeting energy assets across neighboring countries like Kuwait and Qatar, which actually pushed oil and natural gas prices even higher. And that changes the whole equation immediately, because now the market is not just only reacting to headlines, they are reacting to more physical supply risk on top of just oil. And this is the moment where we saw the market started to flip, right? That there were reports that Qatar could actually lose 17% of their LNG capacity for potentially years, effectively sidelined for years to come. Okay, then this is not weeks, this is not a temporary disruption, and this is a hit that will affect global energy supply. And once the market starts pricing that in terms of natural gas, it flows back down to inflation once again. And that's the reason why we saw fear spiking up. And the reaction of what we saw in oil was instant, even though we saw that what affected was natural gas, but because oil was still the main predominant risk, it was factoring into oil prices, right? We actually saw Brent crude oil surge above 119. We saw WTI crude oil push towards 100 details. Now, the important detail was not just about the price going up above $100. It was, in fact, the spread between oil prices. So what you see here are four different oil prices: Brent, WTI, Oman crude oil, and Dubai crude oil. So what can we see is that Oman crude oil is now at around $153, and Dubai crude oil is about $130. And what we saw, Brent and crude oil, this was an earlier chart, but at that moment in time, it was at $103.95 just 24 hours ago. So you can see that why is Brent and crude oil behind? Because they are priced based on US and European supply conditions, while the actual disruptions that we see is happening in the Middle East. And what does this mean? It means that the shortage that we see might not have been accounted for yet. So this divergence is getting bigger and bigger. And if the Strait of Hormuz continues to be disrupted, we will see this divergence narrow, and as Brent and actually WTI will ultimately price higher to be closer to what Oman and Dubai crude oil is. And what this tells us is very simple, that the market was putting a much more higher premium on globally traded oil than on US domestic supply. And it's a matter of time before we might see the US domestic supply actually creeping up even higher to meet the oil in Dubai and Oman. Now, once oil moves like that, everything starts to fall in place, right? Higher oil will actually lead to raised inflation expectations, and raised inflation expectations will lead to restricted central bank policy, which is what we saw the Federal Reserve did. And this will push Treasury yield higher, because when Federal Reserve is more restrictive on their policy, it means that they might not do any more rate cuts, and uncertainty will also cause Treasury yield to be pushed higher. And this will then add more pressure to stocks and equities. So what we saw was the market trying to reprice this entire chain reaction. And this is what we saw in the Treasury yield. It pushed up towards close to actually above 4.3% today. And when yield gets higher, what it means is that people are expecting rates to stay high. No rate cuts, higher borrowing costs. And if we do see yield stabilizing and moving down towards possibly 4 here, then we might be able to see some footing in stocks. But if we start to see the 10-year yield pushing towards 4.5, that is where the pressure starts to become super, super aggressive. And we saw a reaction not just in stock, but across all other assets as well, even gold, which was supposed to act like a safe haven, but we saw quite a huge correction from 4,008 and it actually dropped until 4,005 on the day. And even though it is holding this 100 daily EMA, now you can see of how gold has repriced and accounted for what is happening. So interestingly, when as gold is a safe haven asset, right? When market is on a risk-off behavior, you will tentatively want to see gold going up. But the fact that gold has pulled back to the extent, right, it shows that this is affecting all asset classes, and it is also possibly because of how gold has ran up earlier before that has caused some sort of weird divergence that is happening, and this weird inverse relation that has now been crushed as well. And when we look at Bitcoin, similarly, we saw the same thing as well. Bitcoin actually went down back below 70k, and now it has found some level of footing at 70k, above 70k once again. And even though we did see it pushing higher to 75k earlier, but geopolitical events and macro is still a drag, right? And when all of these assets move down together at the same time, what does it mean? It means that the market is de-risking. Simple as that. It is hedge funds, investors pulling exposure all across the board and not wanting to be in any risk-on behavior in any of the assets. Now, in the afternoon session, we saw some positivity coming where things shifted a little bit. There was a little bit of bounce, which caused what we saw the S&P to close higher than where it opened at, even though it was in the red. So oil cooled slightly, and it was due to the comments from Israel Prime Minister, who actually said that Iran is decimated and Israel acted alone in strike on gas field. So what market interprets this is that, oh, Iran is decimated. That means, oh, possibly the war might not be prolonged longer. So this was a little bit more constructive. And he also said that the Prime Minister also said Iran no longer has uranium enrichment capacity. And that was enough to trigger that relief move that we saw. Because after a sell-off that we saw, market needs a reason to believe that this worst case scenario will not happen. But here's one important, that bounce that we saw did not really hold cleanly to push the market up. And the reason was that the message was not truly a de-escalation message, because there were signals that conflicts will still continue. And the Prime Minister still also warned that ground component was still possible and trade routes were still at risk. So this bounce that we saw was more of a short-term reaction and not really a full resolution. At the same time, VIX is still elevated. It's roughly sitting about 23 right now, even though it has fallen from yesterday where it went all the way up to 26. So it is still at elevated levels, but there's some level of panic, but not to the extent. Of course, we do want to see VIX going down lower and trending below 20 for us to be considered where it is a much more calm environment. But right now, any single news might push us back to the resistance of 28 once again, which means that there is definitely still some more room for volatility. Also today, there is an important event coming up, which is called triple witching. So for those of you who don't know, triple witching is this quarterly expiration of 3 financial derivatives: stocks options, stock index, and stocks future. Now, this is not really a bearish or bullish sign, but it will probably lead to increased market volatility due to the simultaneous expiration of stock index future. Now, so we could actually see some sort of much more volatility. We might see VIX repricing this as well, because we might see shorts covering alone, and that could push markets higher quickly. But that would not be super surprising, because whether it will be a short-term bounce or a recovery, these are two different things. And for us to see a sustained recovery, it's not just one single day. We do want to see over the next few weeks as well. And Micron is a perfect example of what we are talking about, of how the volatility that we are seeing now is flowing down to all companies, even though they are producing some wonderful results. So Micron actually just released their earnings, and look at what the CEO said, that it cannot deliver enough memory to key customers after blowout earnings. However, the stock still actually fell. It was down from this close is about 3.78%, if I remember. Because right now, the market isn't really rewarding super good stories, right? It is reacting all to the macro pressure that we saw. And when macro dominates like this, even strong companies that we see, which are right in the center of the AI build out, can struggle in the short term. So here is a simple way to understand how the market is based on what we saw yesterday. Now, first off, the short-term moves are of course noise. Whatever they are seeing now is extremely loud. Extreme fear is back below 20. And the underlying pressure is the real signal that we want to look at. Now, the market can bounce anytime, but what actually matters is whether oil prices, 10-year treasury yield, and the key support levels are being held on and supported and stabilizing. And without that, any rally that we see is probably temporary for now. And second, this is a condition-driven market now. It is not a sentiment-driven one. So the direction is no longer about optimism or fear. It is driven by macro forces like oil prices, natural gas prices, inflation, and interest rates. Okay, forget about rate cuts, right? It's whether will there be rate hikes. And this needs to ease before markets can actually see a recovery. And last but not least, of course, discipline beats prediction in this environment. Many people are just saying that, oh, it will continue to go down lower. It will go all the way back to the April 2025. Is it possible? Of course, it is possible. But when we invest, it's not about calling the exact bottom. In fact, no one knows where's the exact bottom. It is about focusing your attention on quality, companies with strong balance sheet, strong cash flow, and at reasonable valuations, because I can tell you that right now there's a lot of wonderful companies right in the center of the AI build up that have very reasonable valuations. Because while volatility is scary for some, it does create opportunities, but only for investors who stay patient and stay in control and be rational. That's all I have for you for today's video. If you do enjoy such content, be sure to hit that like and subscribe button. If you have a friend who you think might enjoy and learn something from this content, would appreciate it if you could share it with them as well. And this will also help me to create more of such content for you. So thank you, and I'll see you in the next one.